You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 30th of March 2025, and I'm joined today by our special guest, European dividend growth investor. But firstly, thank you very much for coming on the show. Could you just briefly tell us how you first became interested in investing and just talk us through your investing career to date?
Yes, of course. Look, it's actually very simple. I was in my early 30s, and at a certain moment, I was working on my career, had everything settled, house, wife, kids, these kinds of things. In a certain moment, after a few salary rises, you just start to have a little bit of money left at the end of the month. So then the question was like, okay, so what am I going to do with this? And then you see what's happening to your savings account in a zero interest environment. Nothing. But then you read inflation. Oh, inflation is 2-3%. The same time, I'm from the Netherlands, born and raised. You look at the pension schemes there, and you see that for over a decade, the big Dutch National Pension Fund was not re-indexing their pensions. So what re-indexing means, like, if there's 2-3% inflation, they should also re-index your future payments, let's say, for when you turn 65, 67, also by 2-3%. That was not happening. So I thought like, hey, wait a second, over 10 years, I lost like 20-30% of purchasing power. And at that moment in time, I also took up somewhere a book on an airport, which was about becoming mortgage free. And in that book, it was all about, let's say, every month, putting €100 down in your mortgage and therefore lowering your absolute mortgage payment, monthly mortgage payment. And then the ones that the euros that you saved on, redeploying that again in the next down payment. So you made from €100, €101, €102. And that's where I learned the lesson about compounding. And you need to know, right? I come with a high education, university degree, and then only in your 30s you discover really what compounding means. When looking at that at a certain moment, I thought like, okay, I can continue paying down my mortgage, but is there anything else there? And then I read something about passive income. So I started Googling on that. And that's when I stumbled on the blog from Jason Fieber. Jason Fieber was a very well-known blogger in the dividend growth investment space. And from that moment, I was hooked on. I felt like, oh, wait a second. I can just invest in really super quality companies. They pay out some profits back to me, and I get to have that as money, and I can do something with that. I can pay bills with that, and that hooked me on from the first moment. And so that was really what it was for me. What I really started investing and what I call investing. I must say that when I was 25, I was also I started working at that time. I had a few colleagues that were in the stock market. I remember buying some KPN, the Dutch telco, for €200. And at that moment in time, I was just getting nervous. I was the whole day behind my computer at work, sneaking on what the stock market was doing. And then it was 2% down. And I felt like, whoa, I lost €4. There goes my lunch meal. Yeah. And I was thinking like, oh, I made a bad investment and everything. So I did that for a year, and I felt like, my €200 turned into €200 after a year. And I felt like, okay, why am I doing this? I can better put it on the savings account. When you store it on a savings account, you can't lose money. It's safe there. Yeah. So that was how I was thinking at the time. So it really took me then 7-8 years longer to really understand what investing is. Not speculating, not trading, truly what investing means.
What was it in particular that attracted you to dividends rather than, say, for example, more growthy stocks?
I guess I'm conservative by nature, and I don't mean that from a political point of view, but I don't like debt and all these kinds of things. I guess I prefer to protect my capital, as how you would say it nicely today. And what I liked about dividend growth stocks is that I kind of understood those businesses. I understand Unilever, yeah. I understand how many shampoos they sell. I use their products. I understand the ice cream, the magnums. I can experience it myself. So this is what I really liked about the blue chips company. They're boring. They're slow compounders. Slow compounders means also you get a lot of signals when they are getting into trouble, let's say. And the fast-paced environment, the growth stocks, they were too hard for me. I want to understand what I own. So that's one category. So it's typically more companies in the later cycle. But I don't know if you have experienced that, but when you see a dividend coming in on your account, and you know it's kind of yours. There's something magic to it. Just knowing that, I don't know, now it's about the hundreds, but this first time, like, oh, I got €6 from Unilever. I can buy 2 Magnums for this. Yeah, I've got my Magnums paid for this quarter because I don't eat so much ice cream. That whole realization and then understanding what I mentioned earlier about the impact of compounding, that the €6 will become €7, €8, €10, and that it grows exponentially. Yeah, I think there's nothing nicer than that. I know there's a whole conversation about buybacks and dividends being tax inefficient, but what I like is the dividends. I can do whatever I want with it. Yeah, I decide where I want to reinvest the money while I'm in the accumulation phase, not management. So I like that a lot.
Just out of interest, where you've mentioned the dividends being more tax inefficient, do you have any? So in the UK, we've got what's called an ISA, where you can put up to 20 grand a year in tax free, which means you can build up quite a big portfolio and take your dividends before you pay any tax. Yeah. Is there any Dutch equivalents?
So I can't tell about the Netherlands anymore because I don't live there. I live now in Poland. In Poland, we have something similar, but it's kind of a tax-free retirement account. But it's only, I think, you get access to it when you're 60 or something like that, or 65. I don't know the exact anymore. So yeah, something like that exists, but I'm not going to wait until 65 before I quit working. So I need my money to work for me now. I want to work at 24/7 for me. So I'll take the tax inefficiency just on the chin. But what I meant more was like on the profits that the dividends the company pays you, the company already paid tax. Yeah. And with the buybacks, they can just effectively reinvest it straight away.
Right.
Yeah. So that's why many people, total return investors specifically, they prefer buybacks over dividends. But I like the stability of the dividend, specifically when we talk about dividend growth stocks. What people don't understand about dividend stocks, specifically companies that want to pay a growing dividend, and I'll relate it to myself. Every time I get my salary deposited on my bank account, yeah, let's say 40 to 50 or to 60% of that goes straight to my broker. Yeah, I can't touch it anymore. So I'll need to do my whole accounting, my whole lifestyle on the other 50%. Because the rest is gone already. And it instills a discipline. If I wouldn't do that, I would probably squander around with money. The same philosophy, in my opinion, also applies to companies. Companies with too much money, they can really better pay the dividend. And if they pay a growing dividend, they instill a discipline on themselves to not squander around and to really invest that money that they need very wisely into their business. And I think that's a quality that dividend growth stocks typically show and demonstrate that I feel is a little bit too less respect for in the investing world. And I strongly believe that investing is about psychology. The same applies to management when it comes to capital allocation decisions. So that's also one reason why I really like dividend growth investing. I don't like the buyback machines everywhere turned on at 40, 50 multiples. It makes no sense for me. If you do buybacks, do it when the company is really having a low multiple, let's say, at least historically to what you may expect from such a company. So yeah, those are my 2 cents about why I prefer dividends as a capital allocation. But of course, dividends and buybacks, like what Shell is doing, the UK company nowadays, yeah, that's the sweet spot, of course. Another one is HP Inc., in my opinion. Also such a brilliant company, low multiple, turning on the buyback machine every time when they have free cash flow left. And then suddenly with Shell, I think they bought back over the last 2.5 years, 20% of their shares. And the CEO thinks that by 2030, they can buy back another 40%. Now, that's not 40% growing EPS then, right? That 40% buyback means like 60-65% EPS growth. That's what I like.
Okay, so on your website, which for anyone who wants to go and have a look, it's EuropeanDGI.com. You've got a page on there that says your goal is to retire at 47. So are you on track for that?
Yes, I'm on track for that. So let's say 2-3 years left. Yeah, it should be possible. And
fantastic.
And you know what is astonishing for myself? In summer 2014, I just made my own G sheet where I calculated how much I needed to invest each month, including reinvesting of dividends, and how many years it would take with the right discipline. And it's just playing out like that. So, and that's really the beauty of it. So I'm almost following completely the plan. So that's why it's so predictable.
What growth rate did that assume you'd compound at?
Yeah, so I've a dividend yield on investment of 3.25% and then a 6% dividend growth rate. I've got a few annual reports on my website. People can look it up. I also wrote one back in January, and it really lists out everything. It's an hour read, so people will need to have the time. But I think my followers, they are typically finding that very inspiring because I write there exactly what I've been doing. And I always calculate the organic dividend growth of my holdings. Because, if you're deploying cash to your portfolio, of course, your dividend growth, absolute dividend growth is going beyond 6%. I think I'm typically averaging between 4 and 5% dividend growth organic, meaning that from the 50 companies that I own or something like that, on average, they grow their dividend by 5%. But it's again, translated back in absolute terms. But my average yield on cost is around, I think, 4%. So in the end, 3.25 plus 6 would be 9.25. I think I'm averaging around 9 if you would do the combined ratio. So that's pretty much according to the plan here. And I would have never expected it, that if you just buy boring dividend stocks and stick to your discipline, that the math just works out. It's just math, which is really the beauty about it. Compounding just takes time. It requires a lot of patience. It requires conviction in your strategy as well, because I think the risk that most people have is that they switch strategy too much. I mean, you remember COVID as well, right? Everyone became a growth investor. If you threw some money at the wall, it would probably stick on Robinhood or something like that, or in space, the Virgin Galactic, and you would make a ton of money. It was hard being a dividend growth investor at the time because there was really the fear of missing out. 2022, some of those stocks 80% down. Yeah. And then many people turned into dividend growth investing. Then dividend growth investing was too boring for people, and they started following the Mac 7. Now we'll see now again what happens with those shareholders. But I think choosing your strategy wisely, very closely to your own character, I think is one of the best decisions to make, and then have the discipline to stick with it. If you're more like a fast-paced person, by all means, be a growth investor. But stick to it, because I think the most painful for an investor is to just step in, step out, typically then ending up like, buying high and selling low.
Could you talk a bit about your investment appraisal process and how you would approach looking at a new stock or a potential investment?
Yes, of course. So I would say, I used to do that. I would typically screen, but I do this, as you mentioned, as we discussed a little bit before. I've got a podcast as well, so I must have like 200-300 stocks on my radar continuously, just in the G sheets, the trackers that I have. So I don't really screen anymore as such, but usually I would just screen on those filters, right? I usually have a minimum screen of 2.75% dividend yield. I do know that I filter out with that the Visas of this world. Why? Buying a stock at a 1% yield or a 0.7% yield, it would take a lot of double-digit dividend growth and many, many years for me to become, really contributing to it. And I don't want to wait 20 years for getting a decent yield on cost. Yeah, and I'm talking then about 7 or 8%. Well, I can buy a Dutch insurer at the moment, which pays a 7% dividend maybe, and grows also at 7 or 8%. Yeah, so there's opportunity cost related to this, and I need some cash now for the compounding to work, and I'm not so much interested in capital appreciation. So from that point of view, I look at that. I have those minimum requirements, but then once I know that, it's all about the dividend safety. I just don't like a company cutting a dividend, so I'm really focused on the dividend safety. And I ask 5 basic questions there. First of all, has the business been growing top line and bottom line over the last 5-6 years? Is the balance sheet strong? So I look at debt equity, I look at interest coverage. Has the payout ratio, both from EPS and free cash flow, enough room to continue paying the dividend, even if the EPS or the free cash flow would be, let's say, flat or something like that for 2 years because the business is having some setbacks. I want to understand what the explicit dividend policy is. And many European companies, for instance, they say 40% from earnings. It's kind of not something I like to see. I prefer to say like a clear, declaration for a progressive dividend policy. But of course, one thing is what they say. I also want to see what the track record is. And, sometimes a picture speaks 1,000 words. But if you see a dividend growth curve of 20 years, like Spirax, which we may talk a little bit later about, 30 years of consecutive dividend growth. I mean, do you need to know more about management's attention to the dividend growth? But all these four are a little bit backward-looking views. So the fifth one is like after reading the annual report, doing some assessment about what the business really is, I ask myself the question, is this company able to grow its business, let's say, and will it be better off 10 years from now than where it is today? And how much better will it be off? I think Microsoft, I see that as a very, very strong growth company, dividend growth as well with that. So they're on fire. The flywheel that is going on there, I think they will be much better off in 10 years today, business-wise, than where they are today. Question is, of course, how people will appraise the stock at that moment in time. But I think the business will be much better, which means also that I expect the free cash flow to grow, which means that it creates space for the dividend also to grow. So those are really the 5 things I look for when assessing dividend safety. And then after that, I figure out what I would like to pay for such a company. And I use a bit of a mix. Like I look at the dividend discount model. I think the dividend discount model is a much better valuation for cyclical companies. Think about Shell, BP, through the cycle. You can't really put a cash flow expectation on it. But if you believe that the dividend is the only return you will ever get as an investor, and if you think it can grow because of their debt position and everything, and the commitment of the company, then I think the dividend discount model is probably the best one to apply. But for a stable business like Unilever, Johnson & Johnson, I'm more of a fan of the discounted cash flow model. And last but not least, I often use the multiples a little bit as a litmus test. I've learned that if a multiple around, let's say 15 to 18 comes out for a typical consumer staple, then usually you will see that it's fair valued also based on the discounted cash flow model. So I always see them a little bit in sync because in the end you play there in the discounted cash flow model. You also play with terminal multiples and such. As they say, right, it's more an art than a science valuation. So in the end, what matters most is what is the yield, what is the payout ratio, and is the dividend safe? If that all equates well, then typically I would say a company is probably fairly valued.
What's the best book that you've read on the subject of investing? And you can give more than one if you want.
Well, that changes over time, right? The appreciation about books. And I don't know how you see that yourself as well, but I would say most recently just Charlie's Almanac. After his death, I took it from the bookshelf again and started reading about it, reading the pages more about his life, the wisdom that he all got. Investing is psychology, I believe. And Charlie understood that. Actually, I probably learned it from Charlie to say that. But, One Up on Wall Street from Peter Lynch really inspired me. Because you know what? It's such a home, garden, kitchen book that you can give to everyone and kind of, it inspires. But then if you think about dividend investment books, I think the single best investment, I forgot the author's name, and then Dividends Don't Lie from, I would say, the grand dame of dividend growth investing, Geraldine Weiss. She just died, I think, 2 or 3 years ago. Such a shame, but really good book.
How have you evolved as an investor?
So I think, in the beginning when I started, I took a lot of inspiration from others. And I made mistakes with that, like following Jason Fieber's purchases and such. I made mistakes with that. I burnt my hands a few times on that. So that's where I really learned that you can't borrow conviction. You really need to make up your own mind. You really need to put an effort into it to understand the company. And whether you like it or not, if you can't read the 3 financial statements, if you don't even understand a single word on it, it's probably better to not invest in single stocks. But I just buy an ETF and think about the industry that you're bullish on or something like that, and just buy an ETF and dollar cost average. So I learned all of this stuff. I remember also a lot from university, so it was quite easy. It's funny, right? You go to university, you learn about financial reporting and everything. You learn how to read the stuff. You do exams about it, and then you go into the real world. You put your own money at work, and that's where you really start to understand like what a financial report is for. But I would say how I evolved as an investor from that point of view is just with all this learning into account, I make less and less and less mistakes, and the key differentiator is focusing on dividend safety, not on valuation first, or because with valuation you quickly fall into value traps and such, and on the hype from the day. But if you focus on dividend safety here, which means you very much understand the business, and I want to highlight that as well, right? Because there's often this kind of feeling that dividend investors are kind of stupid. They do for the dividend. But I wanna really give this disclaimer. I'm a dividend growth investor. First, I need to see a growing business. That's the single most important, because then I know they can pay out a growing dividend. It's not the way around. I'm not first interested in the dividend and then hoping that the business grows. That's not how I invest. That's why from maybe the 500 dividend stocks, maybe 450 are not even interesting to me, because they have the wrong priorities. They may not grow. And I want to clarify that, because there is a bit of a dogma sometimes against dividend investing, but that's why it's so important that we speak here about dividend growth investing.
What are your thoughts on current valuations in European stocks where you're primarily looking, compared to, say, the US, where the yields do tend to be lower?
So I believe just that the US market is a bit too expensive. You know, it's what the idiot wants to pay for it, right? I think Europe you get just much better yields, but for a reason as well. I don't see Europe being so innovative, too much red tape. And it's not just the European legislation. It's even management, the companies, the countries. It's everywhere. It's in our culture. So I think it's also worth paying a premium for US stocks, because they have a better investment climate, they have a better working culture. But if you just look at all the historical valuations, the S&P 500 seems to be very expensive. But if you take the Max 7 out, it's not too bad. If you think about many of the stocks now, Target, Johnson & Johnson, they don't seem too expensive. Also, from that point of view, it's probably good to disclose that I do own 50% approximately of my portfolio in US stocks, and the other 50% is all around Europe. So I do have a mixture of both. I just don't want to only invest in the US for two reasons. One, there are just brilliant companies in Europe. They're also really good. I mean, LVMH, L'Oreal, Ahold Delhaize, Wolters Kluwer, Siemens, best industrial in the world at the moment. We have some really high quality businesses. So why would I need to miss out on them? Secondly, with that, I mitigate also a little bit currency risk, right? For instance, now the last few weeks that the dollar went from 1.2 to 1.8 or 9, my portfolio was kind of like a hedge. It stayed flat. So if you think about portfolio value, I think it helps as well to have a good diversification in currency.
I feel like I can predict probably where this next one's going to go, given that it doesn't produce any kind of dividend. But what do you think of Bitcoin as an investment?
Well, if you're a total return investor, and I say this with a little bit of sarcasm, but there's also truth to it, I think you should be full into Bitcoin, because if you look over the last 10 years and total return is your main goal, it's been the best performing, I think, asset over the last decade. So anyone that always comes to me and say, I'm a total return investor, and they say they're investing in stocks, I don't understand it. And if you look at it from a risk-reward point of view, this Bitcoin hasn't really demonstrated risk. Yeah, if you go into the finance world of risk, it has shown volatility, but volatility is not necessarily the same as risk. Yeah. So if you can bear with volatility, then I guess Bitcoin was and may still be one of the best investments out there. I just own nothing of it because it doesn't give me any passive income. And I don't understand it well enough because I know you can get passive income from cryptocurrency and such, but I just don't understand cryptocurrency well enough to feel comfortable with storing my money in there. I understand businesses. So I don't know about you, Sam, but I learned to have the joy of missing out. Fear of missing out is really not a thing anymore in me, because I see what the compounding has done of my portfolio. I just know that if I turn off all the noise in 2-3 years, I can early retire and I can say like F it to the rest of the world around me. I don't care what they all advise. I've done it then. And yeah, so why would I bother about other investments? Yeah, but I think if you look at Bitcoin, I hope I hope it proves itself as a reliable investment over time, somewhat as what gold has done over the last decade. Let's see.
I wouldn't have predicted that answer. I was surprised by that.
Well, it is right. I think I don't know if you have the same, Sam, but over time, I think I just appreciate that there are like thousands of ways to get rich. And I truly believe that everyone should take that strategy that really is closest to their own character, their own psychology, because it makes it so much easier. And yeah, you can talk about Bitcoin as really a store of value, but that would suggest that I know something about it. So why even go into that discussion? I can only look at the data, and the data shows that it has been giving the best total returns. So if you're interested in total return, I think you should consider it. Now, is it wise to put all your money in one asset? I don't believe so. That's why I diversify.
So we're now done with the questions that are more to do with your philosophy and kind of what made you as an investor. So the rest of the interview is going to be about stocks that are on your radar and that you cover on your website. So firstly, could you just talk about the Noble 30 Index and how it came into existence?
Yeah, once you enter the dividend growth investment community, it's all about David's Fish CCC list, which stands for champions, challengers, and contenders, and it's all US based. There are like 100 or 200 dividend growth stocks on there from the US. And there was no European equivalent, so I thought that can't be the case. And I don't want all my money in dollars. So looking around, and I thought like, you know what, I'll do it myself. So in 2020, I spent 3 months browsing more than 200 investor relations web pages, just taking the Stock 600 as an input. And I filtered first out all the companies that at least I could find on Yahoo that don't pay a dividend. And then I was, let's say 200 stocks. I just went to every investor relation page and I just started data scraping 20, 30 years of reports as far as I could get to get the dividend histories. And based on that, I built the Noble 30. So that was kind of a select group of companies coming out of it. I did make a filter in there to have it at least 5 billion market caps so that we really filter out the small caps. And those were the companies that were all on top. So if you look at it, Nestle, the longest one at the time was also Shell, but they cut the dividend during COVID. So then I had to remove it. But that's how I did it. So it was 3 months of work every evening, sitting down, spending my time scrolling through annual reports effectively, all with the goal to create an own list of dividend growth companies that I may then consider investing in.
The companies in the index listed in any particular order?
Yes, the number one is Nestle with the longest track record, and then all the way to the lowest. I cut it off of 30 because, you can make it 40, 50, but I found like 30 a digestible number. And if now someone would cut the dividend, I'll just replace it with the next in line. And actually, a lot of UK companies are having really superb dividend growth track records. Maybe that's more a question to you, like what makes the UK stocks appreciate so much dividend growth? Because you don't see that elsewhere in Europe. It's really the UK that stands out in this.
To be honest, I'm not entirely sure, but I think one thing that's maybe a contributing factor is that if you look at the FTSE performance from, say, 1999 to present, 1999 is a bit of an unfair data point. If you were to say 2000, 2005, it's performed incredibly poorly. I know it's at all-time highs now, but it's like 10 or 15, 20% above what it was 20 years ago. It hasn't grown at a good rate. And I think because those valuations have been pushed down, I think that you're starting on quite a good yield anyway. But I think as well, when we cover companies on the show, so initially because of the valuation that's getting compressed, so I think you are generally getting decent yields anyway. But then in terms of why the dividends themselves are growing, I do find that with a lot of companies, when we cover them, they can do very well in the UK, but we see that a lot of the big UK companies that then try and go into Europe or over to America, it tends not to work. So I think a lot of them are left in a position where maybe they're kind of just left focusing on that core business.
Yeah.
And I think so for example, I think it'd be too small to be on your radar, but like a company I own is a company called Money Supermarket, and it's a price comparison website. It's a fantastic business. It's got returns on capital very, very high, very, very well run business. It's quite well diversified for a price comparison website. It's got quite a lot of different areas. So, for example, we've had issues with energy in the last few years in the UK, and a few years ago, essentially what was the energy side of their price comparison business basically switched off overnight because we're at a point now where energy prices are so high they've introduced a price cap, which means that people tend not to switch as much because there's just no benefit. And that was like 20% of the revenue just wiped out. And within a few years, they've kind of got back to where they were because the other parts of the business were so strong. The problem is that if you go and look at that business, what you'll find is the payout ratio is incredibly high because although it generates really good returns on capital, they just cannot reinvest that in the business.
Yeah.
So you tend to just get quite incremental gains in the dividend because there's just, I don't think there's as many opportunities to go and reinvest that capital. So another one would be Domino's, which we covered recently, but so they've actually just done a minor investment in the Polish Domino's now, which I don't really understand. But if you look at the UK Domino's, historically, they were in a lot of European countries and it just hasn't gone well. And they've pulled out of them all and focused on that core UK and Ireland business. There's like Tesco, for example, which I'm sure you've probably come across your radars. They were in the US, they were in Thailand, they were trying to do loads of different things. Again, just hasn't worked. And I think it's probably partly because they're just, I don't know what it is, but there just seems to be this barrier in terms of taking these businesses international. And there are some really good international businesses on the FTSE, but there's a lot of them where if you actually look at them, most people wouldn't have heard of them outside the UK. Yeah. I don't know if it's the case maybe that in Europe, because you've got that large single market and you've got maybe one landmass, maybe that's a bit of a cultural thing in terms of it. Like if you're doing quite well in Holland, you can quite easily, maybe not easily, but maybe there's a bit less of a barrier to expand into maybe Scandinavian countries nearby. Whereas as soon as we try and go over the channel, we just seem to really struggle for some reason.
Yeah. I always had a feeling that it's more maybe like you have maybe a lot of like aristocrats or noble people that just have their money stored in stocks and they prefer growing dividends as income. Like that many people that invest, they just prefer income and companies like to offer that because what you see often, like why would Mark Zuckerberg suddenly start paying a dividend? I think just because he doesn't need to sell his shares and he has ample cash flow, so he can, some of the cash flow that remains, he can just pay himself a salary. He doesn't need to borrow against his shares then. So I always had a feeling that this may be also in England a little bit the case. Maybe there are tax benefits to it as well for more the rich people or the company owners. That dividends and a growing dividend are therefore way more interesting as a capital allocation decision. Because in Europe it's typically a certain amount out of the earnings, and you don't see that in the UK. In the UK, is really many companies have progressive dividend policies. So it's for me, it really stands out compared to the rest of Europe.
I mean, one thing about the UK is the US I think is a very extreme example of it, but in the US there seems to be a lot more of a buyback culture, whereas in the UK they just don't really have that. There's not really any pressure to buy back shares from shareholders that I've really observed. I think the other thing is, and it tends to be a lot of the time maybe in like the lower quality businesses sometimes, but you will see it with management decisions where like one of our pet peeves on the show is when we're covering companies and they may be going through maybe a bit of a rougher patch, but they can probably get through it and they're still a decent company. But they will borrow to maintain the dividend. Yeah. And it absolutely drives me crazy.
But why is that? Why is that?
I think it's because a lot of these businesses, they're not really growing that much. So it's kind of, if you're the manager trying to talk about what a good job you've done, if you can point to the dividend record, it's like, well, yeah, we're maybe you're not going to have that much of a capital return, but look, we've grown the dividend for 20 years. And I think that's a real point of pride for a lot of managers. And they don't want, especially as well when a lot of the time in these companies, the turnover at the top is quite high because you might have someone coming and going every 5 years. If you've got, like, for example, Shell, like you say, they'd had their dividend since like 1947 or something. Yeah. And you don't, it was a global pandemic, so there's not a fat lot they could do, but you don't want to be the CEO that cuts the dividend for the first time in 60 years. even though there might be 3 or 4 CEOs before you that probably should have cut the dividend, but didn't. But that's what you're remembered for. But I think certainly in terms of maybe the media and stuff in the business section, if someone does cut the dividend, it is front page news, even if it's like a really smart business decision.
Yeah, but in Europe they don't care about it because they don't have that dividend policy. They just say 40% of earnings, so we'll cut it, and so be it. So I there must be something in it. I would say maybe email a few of the investor relations and just ask them, like, why do you have this dividend growth policy? Why are your shareholders interested? Why? Because that's the interesting part, I think, to understand, right? Because we assume a lot now, but I always believe like a company gets the shareholders it deserves. If you focus on dividend growth, probably you get a lot of dividend growth investors as shareholders as well, which with that expect a growing dividend. Yeah. Look at Greggs, is a very popular UK business, I would say. Also really a nice dividend growth track record. But why? It's very interesting for me because they have been given enough capital appreciation. I know, of course, that they went half in share price or something like that over the last year or 1.5 year. But still, if you see it, the wealth it generated, it's been amazing. So yet they're still growing dividends. I don't know. There must be something there. That's just my studying so many dividend growth stocks from so many countries. The UK really stands out. And I always thought like there must be something in the culture there, or tax-wise, there must be something there. Why this and the lack of scaling.
In terms of the ISAs, they shouldn't make a huge difference because it's capital growth or income.
Exactly.
I think it's because a lot of the time the companies themselves aren't growing a huge amount. So it's kind of something that management can point to say, look at us.
Yeah.
But yeah, I don't actually know.
Maybe one day we'll
Maybe. So there's quite a sizable leaning in the Noble 30 towards pharmaceuticals and healthcare. Has that come about by accident?
By accident. I just really stack ranked the top 30 on terms of dividend growth years, and that's the result. So if people are interested, right, on my website, European DGI, I think the Noble 30 index, it's one of the first articles on the homepage, right? You can see them all there. The index is really simple. Growth track record. Stack ranked. There's no emotion to it, no valuation to it. It is really just an index listing everything from number 1 to 30 in terms of years without a dividend cut, as long as it's larger than 5 billion in market cap. It doesn't mean that those 30 I like them. No, it's just a really nice list to start analyzing and start doing your due diligence. But no, healthcare. I guess healthcare is anti-cyclical, and if there's still one sector in Europe where we're still kind of leading, is maybe the big world, but where we still have a right to play, it's healthcare. Think about the Swiss pharmaceuticals, think about Sanofi, think about even GSK and such. They still have a right to play in their industry. And healthcare is one of those, right? We kind of lost it in information technology, right? And energy, materials, utilities. Let's not even get started about that. Consumer staples. We have a few, maybe like Unilever and then Ahold Delhaize and such, Nestle. But if you really think about it, the healthcare, we really have a right to play still, I would say. Also when it comes to innovation.
Well, could you talk a bit about Nestle and what you think of that as an investment?
Yeah, I don't know. I will not curse, even not in English. I don't like it. It's a fun fact. Many people think I own it because it's the number 1 in the Noble 30. I don't have it open in front of me, but it must have had something like 65 years of dividend growth. Maybe 1 or 2 times froze the dividend over time, but we still calculate that as dividend growth. But you know what I don't like? If you look at the last 5 years, it has been borrowing money to buy back shares to squeeze some earnings growth out of it, EPS growth out of it. I don't like that. They've been leveraging up the balance sheet so much. I don't like that. They were just not growing. Some people say like, yeah, but look at what the Swiss franc has done. Yeah, it's only a part of the justification, maybe, that their earnings were not growing so much. But this is for me the example of a company where it's maybe still having a safe dividend, but if it continues the path, it goes only into one direction, that at one time a moment in time, they will have to cut the dividends. So, and I need to see underlying income growth, and the company's just not delivering it. So, and then buying back shares to still give some shareholder return by borrowing debt in a zero interest environment, knowing that later you need to pay more interest on it. I don't like it.
Could you talk about L'Oreal, which is number 2 on the list, and what you like about that?
Well,
or not, as the case may be.
Yeah, in this case, I like it because as long as women want to feel beautiful, they will need L'Oreal. It's as simple as that. The company is a powerhouse all around the world, and you know what I like, they have several brands, right, as well, and they really acquire brands. And what is so nice, L'Oreal is able then to give them global scale. But L'Oreal in France or the UK is not the same as in China. Yeah, in China, women, for instance, have different beauty preferences. For instance, they don't want to get sun on their skin. Yeah, they want to have a white face. While in Europe, we like to look more tanned, right? L'Oreal understands that, and they have products for those markets, really tailored to their needs. That's why L'Oreal is such a powerhouse. And, they are having the more premium brands as well. And if there's one thing, and specifically when women get older, they wanna continue to look young. And L'Oreal offers a lot of solutions for that. They just dominate the space. I said, as long as women want to feel beautiful and the population continues to grow, we're good with L'Oreal, I think.
Okay, so if we go a bit further down, at number 11, we've got Wolters Kluwer, which is one I would be interested to talk about, because what I know them for is where I used to work, we used a software called CCH, which is, they're the company behind that. So I'd never actually considered looking at the company before. But yeah, could you tell us a bit about that?
I just did a deep dive on it. I love the business. I just don't own them yet. They've been always too highly valued, but it's the competitor of Relax, the UK company. Maybe for your listeners, what Wolters Kluwer effectively does, and I think it's in legal and risk and regulatory health care, they provide those huge databases with all the information an expert needs. Yeah, so if you're a lawyer and you want to understand the law about something, you can find it in their databases. So it's kind of the primary toolbox of a lot of experts that are knowledge workers, and that they sell this. It's now also more and more a SaaS business from that point of view. They're experimenting a little bit with Gen AI as well on top of this. It's also one of the risks, right? If Gen AI, like ChatGPTs, have access to similar information and can unlock that information to a lawyer, for instance, then you can wonder about the moat of Wolters Kluwer. But for me, it's a top-notch business. In my opinion, it has a wide moat in the industry. To your point, what you just mentioned, you can't really, if you take your business serious and your research or something like that, you can't go without a subscription of Wolters Kluwer in many cases. So and it continues to compound really nicely. I think it grows between 7 and 10% each year. So I think I'll take that.
I mean, we've covered Relics on the show, but Wolters Kluwer, I find it interesting. I mean, I find it a bit difficult with these ones actually because I work in the industry, but obviously that industry is just one small part of it. So when I see it, I kind of think CCH, but obviously it is so much more. And equally, when we cover Relics, I think Tolly's, that's what it is. But yeah, I see them and I think Tolly's, and then obviously they actually have way more than that. But I think as someone who uses the products every day at work, I wouldn't be. I'm not.
Yeah, and if they hike the prices with 10%, it's not like you suddenly cancel your subscription.
No, and that's it. Like I remember I was in a meeting once, and it was a firm I used to work at got bought by another firm, and they'd gone out and bought like a load of different firms, and they were kind of trying to piece them together. So we were in this room, and it was sort of managers from 5 or 6 different firms, and they were all just moaning about the software in terms of they just jack up the prices, but then no one's gone back to doing paper returns. Everyone's still using it, and you hate it. But I think a lot of the time that is a sign of a good business when people hate it but still continue to use it. In the UK, for example, we've got a business called Rightmove, and a lot of estate agents absolutely hate it. But the problem is you've got to be on there now because that's where people go if they want to let a property.
Yeah, what you may want to do one time then is a heads-on comparison between Wolters Kluwer and Relax.
I will pop them on the list actually because it's just one thing where they've just not really come across my radar. I've never thought to do it, but Relics, it's a business where when we cover it, we always really like it, but it's similar to Wolters Kluwer. We just don't want to pay up for it is the issue.
Yeah, it's the same here.
But we do check in on it every time it's got the earnings out, so every 6 months. So
I would say Wolters Kluwer now are at least at a price where it hasn't been trading for quite some time when you think about the multiples. So it hasn't been on this multiple level for the last few years. So I do think it's becoming into the zone where I'm really, if it continues like this, maybe I'll become an owner of it within the next year.
Okay, I'll have to pop it on my list to have a look at, actually, because it is a business I'd be, because I'd love relics at the right price. The problem is it's just never gone anywhere near it. So
Exactly.
Could you talk about Philips and what you think of that as an investment?
Yeah, I don't like it. I don't like it. It's really simple. Poor management, not a tier one mid-tech player. You have Medtronics and I think Stryker and the others. And Philips also with their respiratory machines during COVID. They have some lawsuits now because some people died because of, I think, the internal foam getting loose or something like that. Please don't pin me on it. But their devices have been fewbar and I think it will also be thrown out at a certain moment because it has now 4 or 5 years of flat dividend and it's not really a dividend anymore. It's now a scrip dividend. So they're issuing shares to do this. And I don't have a rule for that in Noble 30, but I just feel like, they're fooling investors now and for 4 or 5 years. So probably it doesn't belong here anymore. There are much better companies that deserve than a place in this list. I haven't changed my mind yet, or made up my mind yet whether I should strengthen the rules for the Noble 30.
I think with that, if it's been doing that for 4 or 5 years, at some point, it seems like a bit of a precursor almost to cutting it.
I think so as well. So, but I was waiting for it already, but they just continue doing the same. Very poor management, and you know what is the story about Philips? They spun off ASML.
Is that where that came from?
Yeah, ASML.
Oh dear, that was
Philips.
Not a good idea.
You know what they spun off more? And NXP. NXP is also a very, very strong chip producer. So Philips has been spinning off all these companies. And what's left over, they wanted to go in healthcare because instead of being such an industrial conglomerate, but what's left from the healthcare, they're just like second, third tier. And that's the pity. That's the pity of it. They can't compete with Medtronic, Stryker, Siemens even with their healthcare equipment. I don't see them competing well. So,
okay, could you talk about? I might butcher the pronunciation here, but Linton Sprungli and what you think of that as an investment?
I love it. So it's a Swiss chocolate maker. So do you know Lindt, the chocolates, those little balls with the creamy?
Yeah, I know Lindt. It was the Sprungli bit I wasn't sure on, but yeah, Lindt's very popular over here.
Exactly. But you know what one share costs?
I don't. I've never actually looked at it.
Well, more than 100k.
Oh, really?
I think I need to take a top of mind. I don't know for sure, but it must pay something like 1,400 Swiss franc in dividend, a single dividend. I mean, I can't afford it.
That was interesting because I mean, he's nowhere near as bad. But Louis Vuitton, they trade at quite a premium, but it's actually affordable. It's still got a way to go before it catches Berkshire A up, I guess.
Yes, but LVMH is, I think, $600, 600 euros, 630. But I'm talking here about 100,000 Swiss franc, or more. I don't know what Lindt is. I don't know if you have it open, but
I'm looking at it now. It's
a six-figure number.
Yeah, 11,950. Saying as.
But that's not the real. That's maybe the B shares or something like that. Okay, 115,800 Swiss franc. That must be something like 120,000 euro.
So if it's got B shares, have you ever considered just buying one? And
no.
Why haven't you bought the Bs?
No. I mean, PE ratio 40 at the moment. So.
Okay. So the final company, I thought we'd at least cover one UK one. Could you talk about Spirax Sarco Engineering and what you think of that as an investment?
Yeah, and I probably need to update the name because they are now called Spirax Group. I think it's an awesome company. It's really awesome. My colleague Derek did a deep dive on it. 30 plus years of dividend growth. Let's call that out first. But it's an industrial engineering company. It specializes in thermal energy and fluid control. I'm not an engineer, but my friend Derek is an engineer, and they use their products as well. And he's always saying like, this is top quality. Their thermal solutions, I believe they use. They have some pumps, and they're into pharmaceuticals, food and beverage, chemicals, power generation. They're all over the place, high quality products. This whole company just speaks quality to me. And that's what I like so much about Spirex Group. I mean, the valuation was crazy and probably still on the high end. So I don't feel comfortable yet still paying so much for this. But it's one of those companies I think you should be really proud on. One of those companies that actually has delivered over the years.
I don't think we've covered it for a few years. I think we have covered it. I think you'd have to go back years. But I think that the problem is, so where you mentioned that your co-host actually uses the products, I've just never come across it. It's obviously very technical, and I just find with businesses like that, I do struggle with kind of visualizing, well, it seems like there is a moat and it seems like a very good business, but how do I know whether that will be maintained? And I think when you actually work with the products, that answer then becomes a lot easier to kind of, you can sort of visualize it better, if that makes sense. So it wasn't like an issue with the company. It's just I didn't really have any interaction with the product. That was my main issue with it.
But I'll give you some numbers, right? Because sometimes, you need to understand the business at least, right? But revenue in 2014 was 678 million. Now in 2023, it was 1.6 billion. Yeah, and what more? Earnings per share in 2014 were 132p. Now in 2023, 250p pence, right? So they doubled effectively in 10 years. It's a 7% compounded growth rate. I think for a business like that, it's really nice. They have a return on capital employed, typically about 40%, and a return on invested capital also usually hovering around 20%. Now, 2024, they saw some setbacks, so it doesn't look as juicy as it was in 2023. But we know all that the industrial environment has turned a little bit south, and the price went with it, but I still find it a bit too expensive at the moment. So, the numbers at least show that they have been doing really, really well. Also, their margins have been expanding over the years. So, and then the dividends have been growing for over 30 years quite nicely. So, only thing left that always would help me from buying them is valuation, but I think the dividend is safe.
Might have to have another look at that actually at some point.
You have some really good UK companies, right?
We do, yeah.
And
I think we get a bit of a bad rep, but I think you do have to go through them. I think when you look at the FTSE 100, a lot of that's quite stodgy. But when you get down in the FTSE 250, particularly, I think there's some really quality companies in there that do go a bit under the radar sometimes.
So I can tell you which I own. That maybe not all are English companies, but they are listed in the UK. So
sure.
I own Legal & General.
Yeah, we've done that one. So that was quite an interesting one, actually. We did that a few weeks ago. We've just had a budget in the UK where basically they're now going to start taxing pensions for inheritance tax from 2027. And we were actually wondering whether that was a bit of a tailwind for Legal & General because their biggest business, they do annuities. And one consequence of that is it's probably going to make annuities in the UK a lot more attractive than they've been for the last 10 years.
Yeah, true. But I think one of their catalysts that they are looking at is also in the US, right? Purchasing pension plans. Because if you think about UPS, I just give an example, and I don't know if Legal & General is the market for it. The UPS has a lot of pension obligations on the balance sheet. And I believe IBM did it 2 years ago or something like that. They kind of sold those pension obligations to third parties so that they could load it off of the balance sheet. Many US companies have this, and I believe Legal & General, if I remember correctly, don't pin me on it, they're hunting for such kind of pension plans because they could yield really nicely. It's of course very, in the end you're predicting on someone's average age, right? And hoping that they will die earlier so that you earn money from it. But
it'd be actuarial tables in the UK, that's what we call them.
Yeah, exactly. Hey, a second company, also an insurance company, is probably a bit lesser known. I don't know for you, but it's Chesnara. It's a UK company. It's also it's buying pension plans from other companies. Often companies are not interested of having them anymore. They are kind of already closed. So they squeeze the last juice out of it. Have been also growing the dividend, I think, for 24 years, nearly a 10%, 8.8% dividend yield. I think now it's growing the dividend with 3%. So it's for me a really nice holding with that. High dividend growth. Then I own DCC. I believe it's Irish. DCC.
Yeah, I'm not familiar with DCC.
You should look one time into them. It's a nice business. It's a really nice business, but they are going through some transformation now. I own Greg's. It's a more recent holding.
Yeah, we've done Greg's. We do like Greg's. If you were to go back to like the very height of COVID, there is an episode that we did on Greg's where we covered it as one of the six, and we were just, because so many of the stores were high street, we were just like, this is it. No one's going to go back on the high street. This is it. And the way they've recovered, I mean, you just want to sometimes take those episodes down. But we had another one where we did it with Shell, where I'm sure I said something like, we've hit peak oil, and it's couldn't have been more wrong. But yeah, Greg's is the way they bounced back from COVID is that they haven't. I remember as well a few years ago we were looking at their growth targets, and I think we both kind of thought that. We thought they were a bit too ambitious with it. Yeah. We just didn't, especially, I mean, for me, it's worse because I live in the north of England and Greg's is incredibly saturated in the north, whereas in the south, it's not quite like that. Yeah. It's like if you go and walk in like Leeds or Newcastle, it's like you can't cross the road without seeing another Greg's sometimes, it feels like. It's just so popular there. But yeah, the way they've actually recovered from COVID and then gone on to hit those targets, they've done a really, really good job, actually.
Nice. And that one would be hard to scale outside of the UK, I think. But, it's a small position. But my largest position is Shell, which is a UK company now. I went full in at least for my circumstances during COVID, because when they reset the dividend, I felt like. So what people say about peak oil and this whole green movement, they're forgetting one thing. It's a gas company more than an oil company. And if people still look at Shell as preliminary an oil company, I mean, wake up and at least open up once the annual report. Because why I really believe the story of Shell, to go into an energy transition, you can't suddenly turn off oil, turn off all nuclear energy, and think that the wind will solve everything. Yeah, and liquid natural gas, you can ship it from all over the world, and it's a relatively clean energy when it comes to CO2 pollution and such compared to the others like oil and such. So, and after they bought British Gas, I mean, liquid natural gas is really like they have a lot of it, really a lot. And I think people are blinded by their climate philosophy and ideology. And therefore they think, okay, Shell bad. Yeah, all pension funds have been dumping it. I think it's just so naive to think that you can just turn off all energy sources like oil and all of this and think that wind will solve it. But hey, what it means is like that the company is now buying back shares at a 6 multiple at these oil prices, and it's making me wealthy. So I love it. But to hedge that, I've got a bit of green coat UK wind as well, because the UK has this one offers this one as well. I've got some Rio Tinto, not really a dividend growth company. I just bought it once here because I like the business. And then I own Unilever. And I think Unilever is really getting back on track at the moment.
What do you think of the new CEO? Do you have an opinion on it? I know he's a former CFO, so I guess.
Yeah, but I like the last CEO already, the Heinz Schumacher. I listened to the fireside chat. I mean, seeing is believing, but the way he speaks, at least, he sounds like he knows what he's doing. And I think Unilever is a company that is will still be around 10 years from now. They're you see this, right? When companies are struggling to grow, they start to change a lot. Yeah, but sometimes just they are desperate for growth, and they try many things to get back on the path of growth. I thought Heinz Schumacher was turning into that path. Oh boy, and this former CEO beforehand that wanted to buy the GSK, was it the GSK consumer?
Yeah, Haleon.
Oh my God. He wanted to pay 60 billion for it. That would have been a nail in the coffin for the dividend in Unilever. If he would have acquired it, Unilever would be one of the biggest struggling companies right now of entire Europe. So I'm so happy he came to senses.
Well, we never know who actually came out of that looking worse, whether it was Unilever for offering it or GSK for rejecting it.
Maybe GSK for rejecting it. Yeah. Good point.
Yeah, I think time's probably proven them right.
These are some companies that I own. I've got always a few on the radar, like Spirax. I could own. GameShop doesn't have reliable dividends.
Games Workshop?
Yeah, Games Workshop. Yeah, sorry.
Yeah, it's not really. Yeah, it's not really a dividend one. I think it's difficult though because they've just got so many uses for the capital at the moment.
Yeah.
They are just doing really, really well. I think the Unilever one's interesting because that's one of my co-host John's biggest holdings. Yeah. And we both, when we covered it, we very similar opinion to you. We thought we keep calling him the new CEO, but
yeah.
he's obviously gone now. Gone. The former CEO, we thought he'd had a good first sort of 12 months. We thought he'd done quite well, and then the news came out that he was gone, and we were just both kind of like, it's got to be a scandal or something. There's got to be something that's going to come. And then we'd gone to when we went to the Fundsmith meeting, actually, Terry Smith got quite a lot of questions on it.
Yes.
And him and his investment manager just spoke incredibly positively about this. And he basically sort of said, well, the reason he's gone is because they thought they had someone better. And that kind of put it in a bit of a different light. Have you ever looked at Ashted?
Yes, also a really good dividend grower.
Yeah, so they're still on for now, but they're moving over. They're moving their listing to America, unfortunately. So again, that's another one that's going to be disappearing. But
so maybe a disclaimer: I would have owned British American tobacco if my wife liked it. She doesn't want me to own any tobacco, and so our joint portfolio. We've got Bunzl, which is always interesting for me. Sage Group. I get this SAP chills with it, but then for small, medium enterprises, if I understand it well. We've got Intertech Group, which is a potential one. Yeah, and then a few that I mentioned already. And BAE Systems, right? What do you think about that one?
So that's a really interesting one because you go back a few years and it looked like it had quite a lot of issues because it had quite a lot of legacy pension issues. It just seemed fairly stodgy, and then the way they've performed in the last few years has been incredible. We just found the last time we covered it, we thought although the management are doing a really, really good job with it, I think a lot of the valuation now I know geopolitically it's kind of looking like quite, because obviously, for example, we've announced we're now moving 2.5% of our GDP to defence spending, but it made us a bit uncomfortable, the valuation last time we looked at it, because we just think like a lot of these geopolitical factors need to continue to justify the price now, whereas if you'd gone back 2 or 3 years ago, I can't remember what it was trading at exactly, but it was trading at a much, much lower multiple, but whereas now, I think it's gone, I'm going to make up a number, but it feels like it's gone from something like 7 times earnings to 17 or something like that.
Yeah, there's multiple expansion, right?
Yeah, but it's done really well because it was quite a poor performing business for a long time, and they have turned it around. But yeah.
And what do you think about Halma? Halma is also one that I'm always looking at and flirting with. Halma PLC. No, they have 43 years or 45 years of dividend growth. Yeah, valuation is very rich. But
and I think again, I think we've only covered it once and then didn't go back to it. But I think the issue was it's just sort of understanding the business I found a bit difficult.
Yeah.
I tend to be a bit simplistic sometimes, and that I'm very, very liberal with my too hard pile. You mentioned Bunzl though. Is that where it's like 150 different little businesses or something?
220 acquisitions since 2004. So yeah, you're right.
That's it. Yeah, that had stuck with. Not a huge amount else, obviously, has stuck with me.
But then we talk about LVMH and L'Oreal. They're also serial acquirers. Yeah.
The distributing, again, it's just an industry where it's just quite, for us, just wasn't a hugely attractive industry. And I don't hugely like it when companies go out and acquire growth. I don't mind it when there's like, it's complemented by organic growth.
Yeah.
But with Bunzl,
I know what you mean.
Yeah, I think when we looked at it, it was kind of like, well, if you strip those acquisitions out, it probably masked some of the performance slightly, and I think that was what we didn't like about it, because I don't think we came back to it.
Yeah. Oh, good. Yes, but I just showing that there's a lot to pick in the UK as a dividend growth investor, and for us it's very interesting because we don't pay dividend tax on those. Okay. So we don't need to reclaim dividend tax. So the UK is very, very popular with mainland European dividend investors, dividend growth investor, because if I buy it, I pay 0 tax, and I only need to, in my case, I still need to pay 19% dividend tax then, but I don't need to deal with tax reclaim forms and anything. It's just a very friendly country from that point of view.
Okay. I wonder if that's why they don't like cutting the dividends, maybe.
Maybe at least.
Maybe it's not for us. Maybe it's for you. I think that's everything on my side. So, firstly, thank you very much for coming on the show. Assuming there's nothing further on your side, where can people go if they want to learn a bit more about you?
Well, they can find me, of course, on Twitter, handle European _DGI. Then they can find me on EuropeanDGI.com. That's one. And then I'm also co-host of the Dividend Talk podcast, which I hope you maybe one time soon join us to talk a little bit more about UK stocks. So consider it an open invitation.
Thank you very much.
And
nice to brush up on a couple, actually.
That's good. I can send you a list. And then, we have also Dividend Talk EU, but that's more like if people want to go the extra step. So, but hey, if people want to get in touch, I think the easiest is just on Twitter to send me a direct message and reach out.
Okay. Well, thank you very much for listening, everyone, and we'll see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.